algorithmic trading, application of artificial intelligence in financial markets, it is a good idea, but it has a terrible implication for now. First and foremost, it's a paperclip economy. That means that most people are, in my view, doing very futile, useless things. They're not making their lives better and they're not adding any value on the economic front or social front. And therefore, second, a lot of talent is diverted from, for example, working for Tesla and realizing vision for self-driving cars. They're wasting their time trying to predict stock prices. This is the Not Even Wrong podcast. It's June 3rd, 2021. This is Krim Delko. Since the last update on May 30th, we are down 4.4%. For the year, we are now down 16.7%. The market is up 11%. We're underperforming by 26.7%. So I want to talk a little bit about the application of AI in financial markets. I think for us, an innovation hedge fund, this is certainly a subject that we often come across in several topics, actually. And one is always also ours asking the question, well, should we be using AI? What should we be doing? And here is the fundamental situation, the way we see it. First and foremost, when you're active in financial markets, the most fundamental question you have to ask yourself is, what is your time horizon? Because that will determine what kind of technologies you're going to use in the market. So for example, if your time horizon is 5 to 10 years, if your mission is to generate wealth by investing in fundamentally new concepts and innovation practices, engineering practices with large impact, your time horizon, by implication of that mission, has to be at least 5 years, probably more, 5 to 10 years. So if that is your time horizon, you have to use different technologies. For example, in our case, we use reading books. For example, we use talking to academics, talking to people that are at the forefront of science and engineering. That is our main technology. It's a very fundamental, basic technology. And of course, there are questions, could we use more technology? But I'm going to get back to that. Now, if your time horizon is, let's say, 2 days or 5 days, you're going to use different types of technologies. Maybe if your time horizon is a week, you're going to use different technology. And now, to get to the gist of the point, if your time horizon is milliseconds, then certainly you're going to have to use very sophisticated artificial intelligence, distributed networks, neural networks, prediction engines, all kinds of things. You have to be close to the exchanges. You have to have ins with the exchanges to be able to execute in sub-millisecond type time frames. All those things matter when your time horizon shrinks to the millisecond level. So again, what is your time horizon? And then from there, you define the technology. So that also answers some of the fundamental questions that come up in the, well, should you use AI in financial markets? Well, what is your time horizon? And I want to now start with the most, let's say, most prevalent application of AI technology in financial markets, which is this sub-millisecond type algo trading, where people are trying to predict the next move in a stock price, where people are using models that are trying to predict certain certain anomalies, certain let's say reversion to the mean type developments. And I'm sure those models are more sophisticated than that. I haven't worked in those fields myself, so I can't really vouch for what exactly they're doing. But just looking from the outside, I think all these models have to depend on some sort of fundamental thesis of reversion to the mean. And that is also the biggest problem. Or in other words, what these models are saying is, this is how it should be based on the past, and it's different now, and we're going to act and make sure that whatever should be comes back to actually to reality. So let's say a stock should be 5 instead of 4 based on all the past data, and then you basically trade to make the stock go to 5, and then you get out, and then you realize a profit, and so on and so forth. So I think the fundamental problem with all these models is that if they're based on reversion to the mean, then whenever the reversion to the mean doesn't happen, everything blows up and you lose a lot of money and those sort of things. So this is one of the key problems of those types of funds. They also tend to use a lot of leverage. So for everybody who is not in that kind of business and still calls themselves algo trader, heads up. I mean, that means they're doing something more interesting than just reversion to the mean with leverage. But my guess is most of the people that use some sort of algo trader, call themselves an algo trader or use machine learning, that's what they're doing. And I feel like that's why also I mentioned the paperclip economy. What is the social or economic impact of people being able to execute in sub-millisecond type time frames? They would say, well, we make the markets more efficient. I would say, no, you don't, because you're actually making it more difficult for other players to gauge what the real volumes are, or what's called real money on Wall Street. Now, they might say, well, real money is a relative term that sort of human investors, or what Wall Street calls real money, which is actual real investors that pull the trigger based on their thinking, that those types of people will die out, that we will only have machines trading with each other in the future. So that sort of notion of real money is just a myth, and it's going to go away. Are we in that sort of sliver of time, but it's actually a contest between humans and machines in financial markets, or is there a fundamental difference? Do these two things actually not commute, or in other words, are they not even compatible? Can machines really make money in financial markets, or is there some sort of fundamental laws of physics or some other law that prevents that from happening? And I would say right now, I would tend to the latter, which is that fundamentally machines cannot make money in the financial markets because machines are not able to predict the unpredictable. The machines are not able to deal with what's called black swan events, or just very unusual, very weird things that just are not predictable from past data. At least for now, we don't have technology that can do that. Maybe in the future we'll have some sort of conscious AI or something that has the kind of creativity that David Deutsch talks about in his Beginning of Infinity, that 0 to 1 describes the uniqueness, the sort of anti-hamster type behavior of entrepreneurs, that again, by definition, like if you take our own, let's take our principal stack, which is the Beginning of Infinity, David Deutsch, 0 to 1, Peter Thiel, the Innovation Stack, Jim McKelvey, and the Innovator's Dilemma, Clayton Christensen. If you take that principal stack and you derive certain assumptions from there, the one assumption you will get from that principal stack is that you can only make money with things that are absolutely have not been done before, that are not predictable from the data of the past, that are unique, that are different in a sense that nobody has ever done it before, and that also are able to compound knowledge. So there is the law of compound based on things that have never been done before. So these are very difficult concepts for AI today to grasp. So in that sense, I would say yes, it is we're not in this sliver of time where humans and machines are in contest. The humans are going to win out against machines every day when it comes to wealth generation in the financial markets over a long enough time horizon. This is what we are, Orange Capital Partners, is in. Now, again, if you shorten the time horizon and you change the mission from wealth generation to making money, or even gambling, or predicting, or things like that, then of course machines are better. But that's not the contest. This is not wealth generation. Betting on the next move, the next stock price move on the financial market, in the financial markets, is not wealth generation. That is betting, or maybe even gambling. At best, it is organized, probability-driven, betting. And some of these people, it's funny when you talk to, let's say, there is this podcast I listened to recently, Peter Abil's podcast. A bit disappointing that he brought this person on. It's a person from a company called Two Sigma, and they call themselves financial science or something. It just tells you already in the way they phrase it, they're embarrassed about what they do. Whenever you have a job description that involves the word science, I recommend you hold your wallet and walk away. There's no such thing as a job where every job in some shape or form has a scientific component, at least a knowledge job, because if you have to explicitly say that you're doing something with science, then it's just wrong. It's fundamentally wrong. So let's get back to the finance side of things. So now, having said all of this, now is there a role for machine learning in the financial markets beyond the sort of short-term betting, convoluting volumes, driving volumes artificially high, and pretending to do trading when all you're doing is mean reversion or things like that? Is there a role beyond that? Now, my answer to that is intuitively, of course there is. There has to be a way to better use data to make long-term decisions. The same way that, and let's go to a company like Tesla or SpaceX, for example, the two companies that we care about a lot. And think about it. Let's say, is SpaceX using data to better predict their outcomes? And I would say that, of course, they're using data to better predict the outcome. For example, they're using some sort of Byzantine general solution problem to solve the idle problem of computers on a SpaceX rocket. So, for example, that is some blockchain type technology which is being used to make sure that several independent computer systems can work together in a distributed way. When the rocket is launched, in case one of them goes bad, the others can still work. So there are certain things that these types of companies use. Take Tesla. Of course, Tesla is using a vision, neural nets, convolutional neural nets to drive vision, to enable self-driving. So they're using AI to make to enable a service which is, I would say, very, very useful for people and should drive their earnings. Now, can we at the investor level use data or AI to predict those outcomes? Yes, we can. For example, we could try to simulate what Tesla is doing. So we could try to do it ourselves. We could try to build a system that simulates what Tesla is doing, let's say, with AI in vision. And to some extent, we've done that at Orange Capital Partners. We've tried to build very simple self-driving car models and also use them, let's say, behavioral cloning. We use some of that very, very rudimentary stuff just to see, well, is it even feasible? Is it even conceivable that it could work? And the answer is yes. We did find out that it makes a lot of sense that these things could work. So this is one of the use cases, I think, for AI, is in fact you can replicate what the companies are doing with their AI in their businesses as an investor, just to see if it makes sense. But of course, these people, let's say, particularly people that come from companies like Google and Facebook, they have this illusion of control that they can predict, or even Netflix, that they can predict behavior of people by using data. And to some extent, I think they're right. To some extent, they're wrong. The reason Facebook and Google are successful is not because they have good prediction engines, is because they solved a chicken and egg problem and created a network that is very sticky for now, in our view, will be unstuck at some point, particularly through blockchain technology, and these so-called these natural monopolies will crumble. So we don't see a lot of value being added at this point by those prediction engines. Case in point is Netflix. The prediction engine of Netflix is, in my view, terrible, because it really doesn't do much interesting stuff. I mean, what I'm being predicted at Netflix, to me, is very underwhelming. Let's leave it at that. Given how much pomp is being thrown around, and they have this amazing AI that can keep you glued to the TV and all that. It's not true. So I would say that, having said all of that, these people that are coming from those types of companies and trying to make predictions in the financial markets, they're kind of, by definition, are going to fall back into this paperclip economy, which is just try to predict even faster and faster stock moves, and get into this realm of where most algorithmic trading is today, which is this millisecond type trading that, in my view, has no social value, and also doesn't generate wealth, because on average, every now and then they blow up, and then you have sort of a wipeout of the small gains that they make over time. and it's just not an economic value added to society, and therefore also not to those companies. Contrast that with something like Tesla or SpaceX. If Tesla can solve self-driving, already what Tesla has done is enormous economic value to the world. Let's say companies like Salesforce or Microsoft, some of the software companies in Silicon Valley, even Google, with some of their AI, let's say the search engine of Google, I think is amazing, but that's not predicting people's behavior in a sense. That's much more doing solving a search problem in a very effective way, solving text, for example, so making searches more intelligent. That has been to some extent solved, and it's very useful. Those are really useful, economic useful things, and if you can then capture the value added, you can generate wealth. So my conclusion here is the following. I think using artificial intelligence, machine learning, and other technologies along those lines in the financial markets is basically right now sort of limited to the realm of very short-term trading, which is, in my view, basically a paperclip economy, so it's actually useless. It might generate some short-term profit for some, but it usually generates lots of losses for others because every now and then they blow up. So it's not very useful. It actually convolutes the financial markets because it makes volume data very difficult to gauge. You don't know what's real and what's not real. We believe that the real time horizon for wealth generation is beyond 5 years, and in that realm, it's very difficult to use current machine learning technologies to actually really be useful. Some of the technologies that can be used are, for example, to just try to mimic what companies are doing that you're invested in, and see if what they're doing actually makes sense, if sort of a proof of concept or a very sort of light simulation. Those kinds of things are, I think that's where machine learning, as on the investor side, can be very useful. But in order to predict things, in order to predict the next move of the stock price, things like that, again, they are limited to very short-term trading, which in our view is not very useful. Thank you.